Hey traders, and welcome to January recap videos. So many events needs to be recapped, remarkable events, significant events that took place in January. So this video might be a bit long because I will be recapping my trading, I will be recapping the change of methodology, I will be recapping changes in account management, I will be recapping the revolutionary creation of the Fastback test utility. I will be recapping a student of mine created a new completely different pattern, which is very stable, which is very profitable. And I will also recap the creation of my Telegram channel and Telegram group, which also was a significant event as well. Okay, guys, so let us start from the trading results, and we will go one by one explaining all these points of my list. And the first item in my list is this trading. Okay, if you are new to MetaTrader, what you need to do to find your trading history, you need to go to account history, and usually MetaTrader downloads that history automatically from your broker servers. What you need to do is right click and save as detailed report, and save your file somewhere on your computer, and this file will be automatically opened. Pretty standard broker's name, my name, currency, leverage, standard header, I should say it this way, the list of trades that are taken, the amount of what you have generated, you see, and here is some chart and some statistical block. Okay, let us analyze this information. First of all, the first thing that you need to pay attention to is this account balance that I have right now and profits that was generated. So let us find out what I started from, because I didn't deposit any money in January on my trading account, what I started from. To know it, you need to find the difference between the two, and it is very simple. Just do this calculation: 47.9037 minus 16,241, and this number is what I started from. Let me remember this number, and let me type it somewhere here, 31k roughly. Okay, and if you wish to know what was the percent gain of the month, you simply need to divide this 16,241 by this amount. Let's do that. 16,241 divided by this, what we remember it here, and it is 51% generated this month, roughly 51, slightly greater. Okay, why this amount is that big? Why 51%? It is very much connected with the account management, guys, and I will explain it to you in a second. We will first have a look at the amount of winning trades. So profitable trades, percent of profitable trades 56, losing trades 44, the win ratio. Yes, the average winner is greater than the average loss. So together this 1, 2, and 3, they give a positive expectancy for the whole strategy, and you can see that it is trending to the upside. Although we have some drawdowns, I'm pretty sure that we recover that, and I don't even disappointed about this. It is okay. Well, now as I promised you, why we have 51%, and pay attention to this, almost 25% drawdown. Yes, why we have these big numbers, 51% and 25%. As I told you, it is connected with my changes in account management. I should start from the very beginning. Unfortunately, yes, a central bank of Russia revoked the license from my broker, and my broker is no more regulated in my country, and that's why I cannot keep all my money on my trading account, the money I have for trading. I cannot keep it all on my trading account with my broker, because if my broker steals my money, if it blocks my money, I can't even claim any issues. I can't even take him to the court, because it is not obeying the Russian laws. That's why I developed a new account management. I only put very small amount of money. Initially, I wanted only to give my broker funds for one trade, and then I found it very effort consuming, and I decided to give my broker only the funds for 1 month. So I have my money for trading here by my side on my bank account or whatever, and I decide that I will give my broker only this portion, which is 31K, for example, yes, and then deposit it to my account, 31K. So I am trading only this. If I lose this amount within 1 week, I'm not disappointed. I already decided that this won't hurt me much, because it can be 5% of my account, it can be 10% of my account, yes, or maybe it is 20% of my account. The portion that I decided that I can afford myself to lose, so I won't be disappointed if I lose it all, regardless of how I lose it. Maybe broker steals them, maybe I will lose them or whatever, because of my trading. It doesn't matter. I decided that. So then what I did, I split my account by 20, and I found that my position should be, my risk should be 1584 for each and every trade, regardless of the stop loss. If the stop loss is 100 pips, I should choose the position size this way, so to only risk $1584, yes. And if my stop loss is 1 pip, yes, I should also use the position size correspondingly to risk 1584. Luckily, I have a pattern trader system that does this routine for me. It places the entry with the corresponding lot, it places the stops with the levels that I specify and target. That's why you see the risk is always 1590, 1590, 1515, 1599. It is pretty close to 1584. And the lot position size, yes, you can see it is 22 lots, 9 lots, 3 lots. It varies correspondingly because of the different stop loss sizes, but needs to be risked only one amount. Why 20? If you guys know mathematics, 20 is 5%, yes. Why 20? Because based on my back testing, yes, which is 55% accurate, according to my market research, on average it is 55% accurate. The greatest sequence, 20 losses in a row, is the greatest sequence that I have ever met. Sorry, not percentages. 20 losses in a row, and it is very unlikely. That's why if I have 20, it is very unlikely that I lose all my money trading. Simple probabilities based on these probabilities. Of course, you can divide it by 21 or maybe 30, depends on your back testing. Okay, so if I can afford myself to lose this 31K, if I decided to risk it all, so I am okay if I lose 100%, yes, 100% drawdown will be okay for me. And you guys see that if I calculate one position size to risk 5% in each and every trade, 5 losses in a row already give me 25% drawdown, yes. So now you see that this drawdown is not actually the drawdown of my total funds for trading. It is only the drawdown of this trading funds. And as I told you, for example, just let's take the situation when this fund is 10%. So this means 51% generated. It is actually 5.1, 10 times less. And the drawdown of 25% equals to 2.5% drawdown. So now numbers look much better, yes? Now these numbers look much better. 5% generated, 2.5% had a drawdown. Pretty good results. If compounded, it will be very nice rising equity curve. So that's it about the account management. Now the next thing, I will unite the two items from my list together as changing the trading methodology, and this is my website, by the way. Changing the trading methodology and creating the Telegram group, creating the Telegram channel where I post. I would start from the Telegram channel. I created a free channel where I post some of my trades, not all of them, but some of them. When I have time, when I have desire, I post something. And guys, if you look at these trades, you may notice that when a pattern looks like a loser, yeah, you see the pattern is obvious loser. It didn't reverse according to standard rules. I have a take profit. So you see this? Something on here. One more loser, but I have a take profit. Let us find one more loser and I have a take profit. So what is this? You can find, by the way, my Telegram and market research group and a channel. Here are the names: mpstrade.com and MPS Market Research. Join them to have discussion and to have some of my trades. Okay, so why I changed this methodology and what exactly is this methodology? First, the methodology is this: find a pattern, let's have it this way, and instead of buying it, as standard rules say, sell it. And this is based on my results on backtesting, that it is much better to sell it. First, I did a profound test. I did a profound market research analyzing all major players, and I analyzed them with the MPS pattern recognition software, which is the most powerful pattern recognition software on earth, because it is running different swing identification algorithms, so you could analyze the market from different angles, because you know, guys, that there are as many swing identification methods as there are traders on earth. And to find some pattern, it's not enough only to know the ratios of the swings to find a pattern. You should find the swings first, and only then you calculate the ratios between them. So I will just show you the results I had in my backtest, and here it is. Just go to something unified godly. So here are the major pairs, and we just open one, and you can see that we have these algorithms. So each and every algorithm was tested separately, yes, and here's the win probability if you trade standard way. So you see it goes to the downside. If we choose the second algorithm, you have the similar picture. Slightly different, but mostly it is similar. So if we choose the third, we have different but similar picture, yes, with some minor differences. This one is moving sideways, amazing. And so this one is moving to the downside as well. So if I compile them together and calculate the total amount, so the total amount of trades is 722. You can see that the probability of win is roughly 47%. And now, guys, I will show you something that is indeed very interesting thing that I noticed. If the pattern is seen by one algorithm, it has a probability of 47% of win. If it is seen by two algorithms, it has lower probability for it to win. Let's say if it is seen by 4 algorithms, it has even lower probability to win. So what it means that the pattern is seen by different algorithms. As I told you, different traders are using different swing identification methods. This means different algorithm. So trader number 1 sees a godly pattern, yes. Trader number 2 sees the same godly pattern, but he arrived to this pattern calculating waves differently, calculating swings differently, but accidentally these traders coincide in their wave identifications. So it may happen that trader number 3 also coincides and sees this pattern, and trader number 4 sees the same pattern. So the pattern is obvious to all these 4 traders, and they agree that they see the same pattern formation. Yes, so this is what I call obvious. So the more traders see the pattern, the more obvious is this pattern. Every trader is agreed that the pattern is there, regardless of what swing identification method they use. And the more obvious is the pattern, the more likely it is to work this way rather than this way. And it is based on the results of my backtest. So you see, when it is seen by at least 4, we have 44. And when it is seen by at least 1 algorithm, we have 47. So it is a tendency there. Okay, let us analyze some other pair, maybe, for example, just do some random stuff. Dollar Canadian, I don't know. What is the result? So we have this 46% if we choose them separately, each and every 48%, and so on. So let's go straight to total and let us see how this obvious rule affects the trading. And again, totally, if you use all the algorithms and you will simply delete the duplicated one, you will have 765 trades. This is not a small number. And again, if the pattern is obvious, it should fail. It has a higher probability to fail. This means that this number should decrease. Okay, if it is seen by at least 2, we have 45. You see, compare 48, and this one is 45. If it is seen by at least 3, 45. If it is seen by at least 4, it is 45. So obvious tendency here as well. What else can we check? We can check some other pair, maybe pound dollar. I don't know if the pound dollar supports the general rule of this tendency, but we will see. So if taken separately, it has 46% probability, it has 47% probability. Some algorithms are better, some algorithms are worse, and so on and so forth. So we have 48% probability, different results with different algorithms. This means that different traders will have different results. So just let us see at the total picture. And so it shows us 45% probability. By itself, it is already a good probability for inverse trading, and no obvious fact will change that. 47, it becomes even better. 47, 47, and even 50. No, pound dollar does not support the general rule of obvious patterns, but by itself, it is a having 45% probability is moving smoothly to the downside. We can check something else, maybe euro dollar. Let's go straight to total, and let us have the results. It is 51% probability. We go next, it is 50. We go here, it is 51, and we go here, it is 52. Well, pretty much the same. So pound dollar and euro dollar does not support this rule. And other, maybe euro yen. What euro yen says, we have 47% probability, 45% probability, 44% probability, and when it is seen by 5, it is 42% probability. So you can see that majority of pairs support this rule. Let's go to this. Oh, I don't have total calculation yet. So what else should be checked? Maybe dollar Canadian, dollar yen. Okay, enough for that, all the major pairs. So majority of all major pairs, they support the rule that the more obvious is the pattern, the more likely it is to fail. Euro dollar and pound dollar say that it doesn't anyhow affect the pattern, but well, it makes no difference. Others patterns do support that. Other pairs do support that. Okay, how did I calculated that many patterns, hundreds and hundreds of patterns, thousands of patterns. So you see one Excel spreadsheet only contains 700 of trades, and you just saw that I have an enormous number of these Excel spreadsheets. So thousands and thousands of patterns calculated. This is because I created the Fastback test utility, and let me show you how it works. So I will simply attach one to the chart. I will name the output file, and let's say I'm analyzing the Prax algorithm, Prax 12. It is the period of the algorithm, and let me change the language, Prax 12. And I will be using one-to-one target. That's why I'm using this code of target 12, and 5 digits is true. And the D point ratio is the retracement of XA. The C point ratio is the retracement of B. I can specify this. And the complementary D point is the B to C inversion. That's why I also specify this. Okay, I click this OK. Then I go to history of the chart, disable auto scroll. Choose the date to start from, and simply pressing some keyboard controls like this, this, and this. Done. So you see simply here, this Fastback test utility collects the data for me. Maybe this one should be typed this, and writes them down into an Excel output file. Let me show you how this Excel output file looks like. We'll go to files, go to this Excel. It should be Prax $60 because we were analyzing this $60. So this is the time, entry, stop, target, risk to reward, result, and then we collect B point ratio, C point ratio, D point ratio, and D2. Of course, you can go, after you have collected thousands of this data, you can go to sort these things and to filter them, and you can set some filters. For example, you want your B point only be from 0.1, oh sorry, it was 0.7 to 0.8, yes, and you will see how many trades are winners if you use this filter. Of course, right now we don't have any trades that fit this criteria, but this was the way how the new pattern appeared, and how a student of mine created a new pattern that is called the McDaniel pattern. Let me show you the Excel spreadsheets. That all these Excel spreadsheets were created by the Fastback test utility that I just demonstrated to you, and all my customers, MPS customers who get the license of the MPS, they have this Fastback test utility for free, and it simplifies the process of backtesting. So we just backtested all major pairs using this Prax algorithm. Prax is the most common algorithm, so typically we start from this algorithm and then we check the patterns on other algorithms. So you see all major pairs were backtested, and just let's have a look at this dollar Canadian. Yes, by itself the naked pattern is 59% accurate. Yes, and if you do the optimization, so we have 471 trades to optimize the C point, and you say, okay, show me only the patterns that are, let's say, having this point, C point, from 0.9, sorry, show me only the patterns that have this range between 0.9 and 1. So this is nice for demonstration, and then you choose these results, yes, all the results, and you do the calculation into different Excel spreadsheets. So totally it has a positive expectancy. The total sum is pretty good. So this way you optimize it to find checking is from between 0.9 to 1, from between 0.8 to 0.9, 0.7 to 0.8, 0.6 to 0.1, and one by one you check all these ranges, and then you type them in the separate Excel spreadsheets, and you calculate the results for all these ratios, and you're trying to find the tendencies. So if this ratio is greater, do you have better results? If this ratio is less, do you have better results? So then you choose them. And we found some tendency, and by optimizing this B and C point of the pattern, making the range a bit tighter, we ended with this results by itself. The naked pattern, as I told you, is 59. If it is optimized, only one point optimized, it is 61. And if B and C points optimized, it turns into 72% probability. Okay, don't save it. So let us have a look at the total master spreadsheet. This master spreadsheet compiles the results from all pairs into one place, and you can see that totally we have 1,600 trades. Pretty great sample size. And because some pairs are optimized good, like this dollar Canadian, other pairs may be optimized not that good. For example, we had 56, and when we try to optimize, we have 57, and when we try to optimize further, we have 55. So you see, other pairs are not susceptible to this optimization. So the total results shows this, the general pattern. Generally, it is when you use the specific ratios for B and C, the results become better. So naked pattern is 59%, optimized is 60%, and the final pattern is 62% correct based on initial starting amount of 1,600 trades, and after these trades being filtered according to the rules, we end up with 600 trades, which is still the great number of patterns. So thousands of trades setups were analyzed, and the best setups were found, and we arrived with this specific trading rules for this pattern. And you see the enormous expectancy. The risk to reward is 1-to-1 with the probability of 62%. It gives you enormous expectancy of 0.21 of what you're risking. So in each and every trade, just imagine that you are risking 1% per trade. This means that in each and every trade you generate 0.21 of percent, 0.21 of your percent in each and every trade you generate. So these are the results of this Mug Needle pattern. Well, I think that's it. I wanna say something else maybe. No, nothing. If you guys are interested in the software, in the MPS pattern recognition software, maybe you are interested, maybe you want to do your backtest as well, and maybe you kind of thinking logically and you say, okay, if I wish to have the same results that I had on history, I should be using same algorithms for real-time trading. And if you wish to achieve the same results, if you wish to do the market research and to become objective in your pattern identification, you are welcome to visit my website www.mpstrade.com. You can also learn the patterns on my website for free. Just click this: harmonic patterns, advanced patterns, other patterns. You can find some of my videos in the market research section. This is mostly the Excel spreadsheets and some video recordings, and you can also find the analysis session to see me analyzing the market in real time, setting the trades in real time, and all this stuff for free. The only thing that you need to do is to register on my website. Okay, guys, that's it for now. Hope you liked this video. If so, give me your thumbs ups. Maybe the information provided here was useful to you. And until then, good luck and good trading. I hope to see you soon.